let's start with this question that 97% of traders get wrong and see maybe you are in that category. Which of these is the real break of structure? Now, most traders get this wrong, and it is probably the reason you have been losing trades. I myself, as a matter of fact, also got this wrong, and for years I thought I understood market structure, but I kept picking the wrong break of structure even without knowing, and the market punished me every single time for it. But if you are in this category, not after this video. By the end of this video, you won't just know the correct answer here, you'll finally understand market structure clearly and how to use it to take profitable trade. So here is it again. Is it A, B, or C? So pause this video right now and type your answer in the comment section, and we'll find out if you are right or wrong at the end of this video. So what is market structure? In simple terms, market structure is just the natural movement of price. Price can generally move upwards, downwards, or sideways. And the way it does this is what we call market structure. Market structure is so important because if you don't understand it, every strategy you try will eventually fail. As a matter of fact, the strategy you are using right now might be actually fine, but the missing piece is that you're not applying market structure the right way to your strategy. So let's break down these movements one by one and pay close attention, because this is where identifying break or structure correctly can dramatically improve your win rate. I'll show you the theory first, then we'll go to the real chart to see how it actually plays out in the real world. So in an uptrend, the market is making higher highs and higher lows. So buyers push price up and sellers push it back down, and buyers push it up again, but this time above the previous high. This is the previous high, and sellers push it down, but this time it doesn't get to the previous low, and buyers push it up again. So this is what we call, this high here is higher than this high. That's why we have higher highs and higher lows. In a downtrend, the opposite is the case. The market here is making lower highs and lower low because the sellers are generally in control, and the movement downwards is going below the previous low that the market has made before. So this is below the previous low the market has generally made. Now, for a ranging market, which is also called consolidation, the market is generally moving between relatively equal highs and equal lows. We're not breaking new highs, we're also not breaking new lows. So let's put this together. So this is the chart together, right? So in an uptrend, the market is making new highs, right? This movement that moved past the previous high is called the impulse move. This move is called the impulse move. I represent it in yellow with the yellow arrow. The pullback that did not break the old low is called the retracement move. So impulse move breaks new high, retracement move does not break new low for an uptrend. In a downtrend, it is the same way but also in reverse. So impulse move breaks the old low, retracement move does not break the old high. Impulse breaks old low, impulse move breaks old low to create new low, retracement move does not break old high. Now, when we have a new high created that moves past the old high, this is what we call the break of structure. So this is a break of structure being made here. So the market moves, does a break of structure. This one is also a break of structure, this one here, because this one is also a break of structure. So if you look at this here, I wrote that this is not a break of structure, even though this movement here even though this movement broke this low. Now, the reason why it's not a breakout structure is because this is the low that made this high. So it is only when this low is broken that we have a breakout structure. So at this point, the market is still consolidating. It is only a breakout structure when the low that led to the high is broken. So if I want to say it again, I can say that for the downtrending market, breakout structure occurs only when the low that made the last high is broken. So this low made the last high. When it is broken, that is what we call a breakout structure. The same thing to the upside. When the high that led to the last low is broken, that's when we have breakout structure. Now, the thing is that not every high or low that occurs in the market is actually a breakout structure. So you see this movement here. This one, yes, we made a new high here, but because the high is caused by a wick, the candle body is not what broke this structure. Therefore, this is not a break of structure. It is actually a liquidity sweep. Now, once the market sweeps liquidity, it usually go in the opposite direction, as you can see here. So this one is not also a breakout structure because this is the last high here. This is the last high. This high led to this low. So this price action we have here has not broken the last high. So this is not a breakout structure. This is just an internal consolidation. This is when the structure was actually broken here. But at the same time, you can see that it is also not a breakout structure because it is broken by a wick. So this is also a liquidity sweep. And when we have liquidity sweep, price usually go in the opposite direction. Just like I said, a breakout structure only occurs when the body of the candle closes above the previous high. So in this case, the body of the candle closes above the previous high. And because of that, we should expect the market to retrace into the zone, which we call the demand zone, and I will explain that later, and continue in the direction. I believe by now you have some clarity on break of structure, but just identifying break of structure is not enough to take profitable trade. The key is how to combine break of structure with supply and demand to find sniper entries. I'll walk you through that strategy in this video step by step. But first, let's go back to a real chart and identify the uptrend, the downtrend, and the ranging markets in a real chart. So this example here contains both an uptrend, a downtrend, and consolidation. But the consolidation doesn't appear where you expect it to appear. So let me explain this so it makes sense to you. So here we have a break of structure to this high. So this one is a break of structure here. So the impulse move broke structure, and what do we have? We have a consolidation and a retracement. This is where we buy. We have another break of structure here. This is the next retracement for a possible entry. Now, if you look at the whole of this section, this high here, if I extend it all the way this way, you will see that the market is not breaking new high. This is more like a sweep, another sweep here, even though it doesn't retrace this, because of course every time it doesn't go all the way down. So all this area from this point to this point is actually consolidation. This is a ranging market. The market is making relatively equal highs and equal lows. In this case, we might not say equal low, but it's making relatively equal high. The next break of structure is this one. This is when we broke a new high, and this is where we should be looking to buy. Then the next one occurred here. Then we have another break of structure at this particular point. But in this case, we are meant to be buying around here. But if you buy around here, what is going to happen is they're going to have a losing trade. In trading, you don't expect to win every trade. If you expect to win every trade, you are not ready to trade. But as a matter of fact, you can win only 40% of the time and still make very good profit. And I will show you how that is possible as we continue. But what happened here is that the market came down. This is the low that made this last high, and the market came down and broke structure to the downside. Therefore, I should be looking to buy at this region. So this now becomes the retracement move. So far, we've been having impulse, retracement, impulse. But in this case, this is also an impulse move. Then this becomes a retracement. Then you can see that this movement here did not make a new low. This one did not make a new high. So also this region, we are having consolidation in this region. And the next break of structure we have is this particular break of structure here. So this is a break of structure, and this is your one to take our buy from. And the market keeps breaking structure to the downside. So here we have our uptrend all the way here and consolidation within the uptrend. Then we'll have a consolidation here within this general downtrend we're having here. This is simply market structure. If you understand this, then you can take very good trade. Now let's look at price action strategy to actually trade market structure. The first thing we need to understand is the concept of supply and demand. Supply is the region where institutions place large sell orders. When price hit this zone, it usually drop. Demand is the region where institutions place large buy orders. When price returns to this zone, it usually goes up. On a candlestick chart, this is how to spot them. Supply zone is a candle before the momentum candle. So this, we have a break of structure to the downside here, and this is a momentum candle. This particular candle here, this is also a momentum candle. Why is it a momentum candle? There are candles that have large bodies with little to no wick, and also the movement is so fast that it created what we call a fair value gap. So if you look at this particular candle and this candle, they did not meet. Unlike this one, this candle wick and this candle wick crossed paths. If I draw this cross here, you see that this candle wick and this candle wick cross paths. But for this one, you can see if I draw this here, so this candle wick and this candle wick did not cross paths. That's what we call an imbalance or a fair value gap. So the supply zone is the candle before the impulse candle that led to the break of structure. So this is where we are going to place our sell order from, because a lot of the time when market goes back to that zone, it usually continues in that direction. So the market is just waiting to pick up orders here and move in that same direction. The same is true for demand zone. So we have the impulse candle. This is it. So which candle led to that particular movement is this particular candle here, because we have a fair value gap here and of course here as well. So this is the same case. When market moves to that region, it usually just continue where it came from. So here is a step-by-step way to use this strategy for both swing and day trade. This is actually a trade that I took. So step one is to go to the 4-hour time frame, identify the market structure, mark out the break of structure, and highlight your supply and demand. So this is JPY. You can see we've been having an uptrend here. The market has been making higher highs and higher lows until we got to this point where it started making a consolidated here, then made a low, which means we should keep going low. But then again, another consolidation, then we have this movement upward. So we're having a break of structure to the upside. So this is a break of structure to the upside, which means now our orientation has changed to the upside. But in general, the whole of this from here to here is actually a consolidation because we're operating between this high and between this high. But within that, we can still find market structure within this range. Let's see what happens. So we have a breakout structure here. Do we have a demand zone here? We have a tiny demand zone here. We have a tiny fair value gap. So this is our demand zone at this particular point on the 4 hour. And you can see the market has already tapped into this demand zone and moved away. The other demand zone we can see is this one here, that the market has also tapped into and moved away. This is the next one that is here, which is at this time is not relevant to our trade because the market is not anywhere near it. So once we have done this, we'll go to the 1 hour time frame and basically do the same thing. Identify the market structure, mark out our demand and supply zone. So again, we have a breakout structure to the upside. So this is now an internal structure. If we mark out our supply zone, this is it. This is my target. So in other words, the market can move up to this point and reverse this way. Okay, so what do we mark out next is to look for supply and demand zone actually. So we're having a breakout structure because if you go down lower, you see this is market structure here. So we've marked out a supply and demand zone here. And can we see more structure here? Maybe not clearly. Then we'll now go down to the 15 minutes time frame to see if it can be clear. Now we had market structure down this way, lower highs and lower lows that eventually led to this bottom, and we start breaking to the upside. So here, internal structure, we have a break to the upside, which means retracement and movement upward again. So we now have another breakout structure here as well as here. So then if we look closely, this is our zone. This is our demand zone. So what should we expect? I can target this high here and place my limit order here. This is exactly how I took this trade. Target the last swing and target this high. My risk reward ratio 3.464. Then let's see how this played out. So we had a tap into that zone and the market then moves away, and this trade took about 2 days. We finally hit our target. So this is simply how it works. Let's look at another market, which is the Bitcoin market. This is another trade that I took. So the process is the same. The first thing we do is to start our analysis from the higher time frame. Okay, so this is, as a matter of fact, let me go to the daily and see that we can do this on the daily. So if you go to the daily, this is our demand zone. You can see that we had a breakout structure to the upside here, and the market retraced into this demand zone. If it breaks this demand zone, we should go lower to here. But let's look at the price action inside of here. That is where we start looking for trade. So the next thing is to go to the 4 hour time frame and see if the market is going to start reversing. Now the pattern I'm looking for is simply this here. I want to see a low, a high, a lower low, a higher high, and then I want the market's going to go higher from here. So we can see that this forms a break or structure to the downside. I want to see it return to form another high to break structure to the upside. Then the retracement into an order block here will give me justification to take this trade higher. So let's see how this plays out on the lower time frame. So this is the 4 hours. Let's go down to the 1 hour. So on the 1 hour, we have this movement down. So we have a low, high, low. We didn't make a new high. This is where we made a new high here. So therefore, this is our order block here. This particular one. That is where we take a trade from. So if I actually took this trade from here, long position at this point, targeting this particular point, I will have actually lost because it took me out. So again, in trade, you don't win every trade. Okay, but this is not actually the trade I took, but this would have been a valid trade to take. Now the market went ahead and broke structure again at this particular point. So it means that this is where this is the order block I should place a limit order from. If we go down further, say 30 minutes time frame, we can actually refine this. So we have an order block here. We have another tiny order block here. So which one should you take? If you wait to take this one, you might miss the whole of this trade. So what I did was to place my entry at this particular point and put my stop loss all the way to this point. Okay, so let's look for our targets. Now, even on the 15 minutes time frame, it's giving us almost the same thing. But I like my risk reward to be at least a 3R. So I move this lower actually, because I know I got a 3R on this trade. So let's see how this plays out. So the market came all the way down and, and we continue trading. Now this is another trade I still took. So this is our next break of structure. This particular one here. Then if you look at this is a very large demand zone. So how do we enter this trade? The same thing, take a long position from this point, target the low, and look left to see the high. So we have actually tapped into this zone. This is the breakout structure here. So we have actually tapped into this zone. So I'm going to target the next high. So we finally had a tap into that zone, and what happened? The market went straight up into the target again. This is important. Only take trades that give at least a risk reward ratio of 3R. In other words, for every $1 I raise, you want the chance to make at least $3. Let me break this down. So if you risk $100 per trade and you lose 10 trades, that is minus $1,000. But if you also win 10 trades at a risk reward of 3R, that is $3,000. So your net profit is $2,000. So even with a 50% win rate, you are still profitable. That is the power of market structure and supply and demand. And by the way, to calculate your risk and position size correctly, you can use the FS crypto calculator. It makes it really, really simple and it's easy to use. And if you like to see how I apply this strategy in real time, because the more you see it done, the more it becomes really, really simple and familiar to you. Attend my live every Monday here on YouTube and even on Twitter. I analyze major cryptocurrency pair and share my possible entries and exits. Also, I have a free course linked in the description of this video. It will help you to deepen your trading foundation. Now let's finally answer the question from the beginning of the video. So A is a liquidity sweep, C is the consolidation, and the correct answer is B. That is a real break of structure. So did you get the answer right from the beginning? Go to the comment and let me know.